So today, we're doing something a little different. We are completely stripping away all that confusing financial jargon, the dizzying charts, and just the endless noise of the daily news. Our goal here? To uncover the simple, timeless truths of building wealth. It's time for the Great Unlearning.
Okay, just think about this for a second. What if everything you've ever been taught about money is actually just a brilliant marketing campaign? You see, the financial industry has built this massive, highly profitable ecosystem simply by making investing look impossibly complicated. They literally need you to believe that complexity equals competence just so you keep paying their fees.
And let me tell you, those fees matter way more than you think. A seemingly tiny 1.5% annual fee doesn't really sound all that alarming when a broker pitches it to you, right? But stretch that over a 30-year period, and that tiny little fee structure quietly consumes over 30% of your total returns. It is an enormous, silent wealth transfer straight out of your pocket and into Wall Street.
Well, this exact mathematical trap is why John Bogle launched the Vanguard Revolution back in 1975. He realized this completely wild but simple truth. Professional investors, as a group, cannot beat the market because they literally are the market. Once you subtract those hefty fees and trading costs, they mathematically have to underperform. Bogle essentially proved that buying a simple index fund and doing absolutely nothing beats a professional working 60 hours a week analyzing stocks.
And honestly, this perfectly aligns with Warren Buffett's literal warning to all of us. He basically views the stock market as just a device for transferring money from the impatient day trader, the guy who constantly buys and sells in a hyperactive frenzy, directly over to the patient investor who just sits back and lets long-term compounding do all the heavy lifting. Now, Buffett's legendary mentor, Benjamin Graham, actually gave this whole dynamic a face. Meet Mr. Market. Imagine you've got this business partner with extreme, manic-depressive mood swings. He's totally euphoric one day, offering to buy you out at absurd premiums, and then completely panic the next, just begging to sell his share for pennies. The big takeaway here? Mr. Market is an emotional servant, whose manic swings you should exploit, not a rational guide whose emotions you should adopt.
But okay, to actually exploit Mr. Market, we absolutely have to shatter this massive Wall Street myth. They constantly try to convince us that risk is the exact same thing as volatility. The normal statistical ups and downs of a stock's price. But volatility is merely a temporary paper loss. Real risk, that is permanent capital loss. It's the very real danger of waking up and not being able to accomplish your personal financial goals when you actually need the cash.
So if it's not the market, who is the real villain preventing us from reaching those goals? Well, surprise, it's your own biology. Nobel laureate Daniel Kahneman showed us that our brains basically have two operating systems. System 1 is fast, intuitive, and highly emotional. System 2 is slow, deliberate, and rational. The real problem is that millions of years of evolution have wired our System 1 to do exactly the wrong thing during a financial crash, which is to panic and run away with the herd.
I mean, we all know that legendary Warren Buffett advice, right? Be fearful when others are greedy, and greedy when others are fearful. But let's be totally honest with ourselves here. Actually executing this is biologically agonizing. When the market is in free fall, our ancient fight-or-flight response is just screaming at us to sell everything. Doing the exact opposite requires immense psychological strength to override our own evolutionary programming.
So, how do we actually fix this? How do we hack our own biology? Well, we build systems. One of the absolute best defense mechanisms for managing emotional crises is a cooling-off period. Whenever you experience a massive life event like a divorce, a sudden inheritance, or having a child, enforce a strict 30 to 90-day waiting period. Do absolutely nothing with your money. Just let those System 1 emotions settle down so your rational System 2 can finally take the wheel for the big decisions.
Now, 99%. Just let that sit there for a second. 99%. It's a staggering, almost unbelievable fact that 99% of Warren Buffett's $100 billion wealth came after his 50th birthday. Why? Because he started at age 10 and gave his investments an 8-decade runway. This right here is the boring, unrelenting, and ultimately mind-blowing magic of long-term compounding.
Okay, but what actually happens when all that compounding works? Well, we really need to get good at separating fake wealth from real wealth. The person driving the brand new luxury car and dripping in designer labels, they are often just a high-income earner, totally stressed out with basically zero actual net worth. The actual millionaire next door? They probably run a scrap metal or paving business, live in a totally modest house, and proudly drive a 10-year-old Toyota. True wealth is the money you don't spend.
Actually,
Thomas Stanley came up with this brilliantly simple formula so you can figure out exactly which camp you fall into. Are you a prodigious accumulator of wealth? Try this. Take your age, say 50, multiply it by your pre-tax income, let's say $200,000, and divide that by 10. That gives you an expected net worth of $1 million. If your current net worth is double that, you are a prodigious accumulator. If you're at half that, well, you might be confusing a high income with actual wealth.
And this brings us to a really massive, deeply ingrained myth that we just have to confront right now. The house you live in, it is not an investment. Yes, obviously it provides stability and shelter, but strictly financially speaking, it is a government-subsidized consumption good because it constantly drains your cash flow through property taxes, maintenance, roofs, and insurance. Your primary residence is fundamentally the exact opposite of a cash-generating asset.
When you realize that, it kind of forces this profound shift in why we're even doing all of this. As Vicky Robin and Joe Dominguez brilliantly point out, true wealth isn't actually money at all. Every single dollar you spend represents the time you worked to earn it. You are literally spending hours of your finite life. Financial independence is really just about reclaiming your time and buying the ultimate luxury, which is options.
But look, reclaiming your time definitely doesn't mean you have to live in total misery. This is where Ramit Sethi's concept of frugality with purpose completely beats pure deprivation. His psychological hack is a real game changer. Spend extravagantly on the few things you genuinely love, but cut mercilessly on the things you don't even notice. It's not about depriving yourself. It's about spending with extreme intentionality.
Now, what if you want the ultimate cheat code to fuel all these investments? 10,000%. That is the absolutely uncapped return on investment you get from educating yourself and upgrading your skills. Think about it, a $5,000 course that gets you a $10,000 raise pays for itself in just 6 months, and then it compounds for the rest of your career. Investing in your own brain outpaces the standard 7 to 10% stock market average by a mile.
So, let's say you've done it. You've optimized your skills, saved your money, and let the compounding do its thing for decades. That brings up the ultimate philosophical question of wealth, one that, honestly, almost all modern finance books completely fail to address. What do you do after you have enough? Because accumulation is really only half the story.
Because here is the hard truth. Money does not magically change your character, and it definitely doesn't solve your internal problems. It merely reveals and amplifies who you already are. Wealth simply provides the fuel to act on your existing impulses. So if you are deeply anxious about money when you're broke, you are going to be absolutely terrified of losing everything when you are rich.
And this is exactly why Andrew Carnegie famously warned, way over a century ago, that the man who dies rich dies disgraced. There is an incredible psychological relief in letting go. Hoarding massive wealth creates this corrosive dragon sickness that turns you totally inward. Giving your wealth away expands your connection to the world and reminds you that money is simply a tool, not the end goal. So, wrapping this all up, after 5,000 years of financial history, thousands of incredibly thick books, and millions of articles, everything you actually need to know about building wealth basically just fits onto this one slide. Save your money, use low-cost index funds, wait patiently, avoid bad debt, build an emergency buffer, ignore your emotional impulses, and give back. It really is that straightforward. Which really just leaves us with one final provocative challenge for you. Will you continue feeding Wall Street's wildly expensive money machine, or will you finally master the person looking back at you in the mirror? Because the challenge isn't knowledge anymore, it's behavior. It's time to take immediate, beautifully boring yet totally extraordinary action.